Cryptocurrency volatility. Is Bitcoin more or less volatile than the S&P 500? Historically, Bitcoin has been discussed in the news and among investors as a nascent and volatile asset outside of the traditional stock and capital markets. Much of the volatility over the past few years can be attributed to sensitivity to small total market size, regulatory hurdles, and generally limited penetration in mainstream stock and capital markets. While Bitcoin continues to be a volatile asset, it may surprise researchers and investors as to what other major assets have been more volatile than Bitcoin. Welcome back to another episode of Money Reviewer. Subscribe to the channel now if you enjoy this type of content and hit the notification bell to never miss any of our latest videos that we upload. In this episode, we will be going over whether Bitcoin is more or less volatile than that of the S&P 500. Let's dive in. Definition: volatility is a measure of how much the price of an asset has moved up or down over time. Generally, the more volatile an asset is, the riskier it's considered to be as an investment, and the more potential it has to offer either higher returns or higher losses over shorter periods of time than comparatively less volatile assets. As a newer asset class, crypto is widely considered to be volatile, with the potential for significant upward and downward movements over shorter time periods. Stocks are considered to have a wide range of volatility, from the relative stability of large-cap stocks like Apple or Berkshire Hathaway to often erratic penny stocks. Bonds, by contrast, are considered to be a lower volatility asset, and typically see less dramatic upward and downward swings that take place over longer time frames. How is volatility measured? When people talk about measuring volatility, they're usually referring to historical volatility, a number derived from a study of prices over a specific time period, often 30 days or a year. The prediction of future movements is called implied volatility, and because nobody can actually predict the future, it's a less exact science, although it's the basis for widely used financial tools like the CBOE Volatility Index, nicknamed the Fear Index, which predicts the next 30 days stock market volatility. Quantifying volatility can be done a couple of ways. You can use a method called beta, which measures how volatile one stock is relative to the broader market. The typical benchmark is the S&P 500. You can compute an asset's standard deviation, which is a measure of how widely its price has diverged from its historical average. Why is volatility important to understand? Volatility is one of the primary factors that goes into assessing investment risk. Traditionally, investors will take on a high level of risk if they believe the potential reward is worth the possibility of losing some of their investment, or all of their investment, as in the recent case of high-risk hedge fund manager Bill Hwang, whose entire $20 billion fund disappeared in 2 days. Traditionally, retail investors are advised to diversify their investments within an asset class as a way of reducing risk. One popular strategy is to invest in a basket of stocks or an index fund, rather than just a few. To further reduce the potential for downside, they may also pair investments in more volatile asset classes like stocks with investments in less volatile classes like bonds. As an asset class that's only a little more than a decade old, crypto has seen a series of steep rises and subsequent falls, and is considered to be more volatile as a category than stocks. That said, higher trading volumes on Bitcoin, by far the biggest cryptocurrency by market cap, and increased institutional participation seem to be reducing its volatility over time. Cryptocurrencies with lower trading volumes or emerging crypto assets like DeFi tokens tend to have higher volatility. When experimenting with these assets as a beginner, it's best to risk amounts you can afford to lose. Factors that can increase volatility include positive or negative news coverage and earnings reports that are better or worse than expected. Unusually high spikes in volume of trading will usually correspond to volatility. Very low volume, as seen with so-called penny stocks that don't trade on major markets or smaller cryptocurrencies, also usually correspond with high volatility. Are there ways to reduce crypto volatility? For some crypto investors, high volatility is part of the appeal. It creates the possibility for high returns. And even as Bitcoin's volatility seems to be declining, it often moves by double-digit percentages in a single week, allowing for strategies like buying the dip. For less risk-tolerant investors, there are strategies that can be used to limit the downside impact of volatility, like dollar-cost averaging. Generally, investors with longer-term strategies who have good reason to believe that an investment will ultimately rise over time don't need to think as much about short-term volatility. And there are now cryptocurrencies specifically designed to have low volatility called stablecoins, including USD Coin and 𝐷AI. These have their price pegged to a reserve asset like the US dollar. Bitcoin is less volatile than many stocks. Cryptocurrency was compared to the companies on the S&P 500 and found Bitcoin was less volatile than 112 of them in a 90-day period. In the past year, Bitcoin was a better bet than 145 stocks in the index. Bitcoin has been blasted by some in the world of traditional finance because of its volatility. While Bitcoin continues to be a volatile asset, it may surprise researchers and investors as to what other major assets have been more volatile than Bitcoin. Much of the volatility over the past few years can be attributed to sensitivity to small total market size, regulatory hurdles, and generally limited penetration in mainstream stock and capital markets. US Bitcoin Exchange Traded Fund, an investment vehicle that tracks the value of the currency, doesn't yet exist, but when it does, it may show similar volatility characteristics as many stocks in well-known indices and ETFs. This isn't the first time Bitcoin has proved to be a better investment than traditional stocks. An investor put $1,000 in the top 10 cryptocurrencies as an experiment, and the digital assets, including Bitcoin, Ethereum, and Bitcoin Cash, came out winning. And with that, we've reached the end of this video all about whether Bitcoin is more or less volatile than that of the S&P 500. Do you invest in cryptocurrency? If so, which ones? Get involved and let us know in the comments section down below. We hope you found this video helpful, and if you enjoyed it, don't forget to like and subscribe for more videos just like this. And turn on the notification bell so you don't miss out on our latest uploads. Thank you for watching, and we'll see you in the next one.